Hi, this is Michael Joyce from Agili, your personal CFO, and I'm pleased to share with you our thoughts and viewpoints for the summer of 2024. As we've reached the halfway point in 2024, the investment markets have actually done pretty decent. The first quarter was a really good quarter, and then we had a little bit of a slip in April. There was some concerning news about inflation, which turned out to be temporary. And the U.S. stock market went down about 5 or 6% during April, and other investment markets also went down. But May and June were pretty decent months, and we made up for that during those periods as well. If you recall, at the beginning of the year, we felt that there would be a lot of headwinds and tailwinds from an economic standpoint in 2024 and beyond. And that has pretty much been the truth. That has pretty much been what has happened. We are seeing a little bit of a slowdown in consumer spending, although it's not concerning at all. And one piece to that is that there has been a decline for the demand for labor. But there's still 1.2 job openings for every person available to fill those jobs. So the labor market is still out of equilibrium. In fact, that was the ratio just before the pandemic, when the economic conditions were pretty robust at that time. But at one point during the pandemic, it had reached a ratio of 2.0 job openings for every available worker. So the demand has slowed down a bit at that point in time. But consumers overall still do have plenty of money to spend. So even if there is a bit of a decline in consumer spending, that's more of a case that we've worked through a lot of the pent-up demand, and we do expect, all things being equal, that there still will be somewhat of a robust consumer spending environment. As I mentioned, households still have plenty of money to spend, and there's a lot of government money that still has to be spent from the previous Infrastructure Act and also some of the stimulus packages that were passed in 2021. Some of these funds went to local and municipal governments, and much of it is still not spent, but it will be, and that will certainly help some of the economic growth going forward. Now, the stock market, if you look at the S&P 500, you would say it's maybe a little bit pricey, which would beg the question, have we come too far, too fast? And I would argue we haven't come too far. You could say that maybe we've gotten there a little bit too fast. But keep in mind that the vast majority of the investment gains over the past year and a half in the Standard & Poor's 500 index have come from a very small sliver of stocks. Last year they called them the Magnificent Seven. This year it's the Fantastic Four, but they've generated more than their share of gains. And those are the priciest stocks in the market, and they have really brought up the price-earnings ratio of the Standard & Poor's 500 index. But if you take those top very large companies, and we're talking about Apple, Microsoft, NVIDIA, that have a disproportionate share of the Standard & Poor's 500 index and other indexes, if you take those out, the valuations of the U.S. stock market are actually pretty reasonable. So we view this as a time where it's not the time to back up the truck and load up on stocks, but it's also not a time to be defensive. I continue to be very happy with the yields that we're seeing on bonds. The types of bonds that we're buying, shorter term bonds, under 3 years, if we're buying corporate bonds, we're still getting in the 6% range on those. We're still getting about 5.4% on very short term 3-month treasury bills, which we often use for both safety and to immunize cash flow needs for clients. But I do believe strongly that those short-term rates will fall at some point. Right now, there's about a 2% spread between the Fed funds rate and the inflation rate. And that's historically very large. At some point, they're going to start to converge. So, and that will be driven by the Federal Reserve. As I said, at some point, and if I keep saying at some point, I'm going to be right, because I'm not making a time prediction for that. But at some point, the Fed will start to lower rates to bring it closer to the actual inflation rate. International markets have also done really well. In particular, over the past quarter, emerging markets have done well. And those emerging markets have really been laggards in terms of other markets over the past couple of years. But the emerging markets have done really well. And one of the leaders has actually been China, which has been a poor performing market over the past couple of years. But the Chinese market has done well, and China, for better or for worse, is still the world's second largest economy. So they do impact the economies and the markets of other emerging market countries. So it kind of makes sense that if the Chinese market is doing better because it was at such a low valuation, that other markets would also do well at that point in time. I also want to spend maybe a short minute talking about cryptocurrencies. You know, cryptocurrencies for much of the year really rose quite a lot. And then in the more recent period, they've fallen off. As I've talked about before, if you're investing in cryptocurrencies, you really have to think about why you're investing in the cryptocurrencies. Are you really investing, or is it speculation? If you're investing in cryptocurrencies, if you think it's going to go up because other people are buying it, that's not really a fundamental reason for investment. And you have to go in eyes wide open if you're investing in cryptocurrencies just because other people are doing it, because it could just as easily fall off. I mean, I think a lot of the rise earlier this year was FOMO. It's fear of missing out. And it was driven by a lot of people who had missed out on the rise of some of the big technology companies like NVIDIA, which really rose a lot in value. So they felt that they'd invest in Bitcoin as another speculative type of investment. I could be wrong on it, but I do think NVIDIA has a lot more fundamentals than the cryptocurrencies have at this point in time. And if you do want to talk about that, you can talk about it with your financial strategist at Agili or talk about it with me. In fact, I am very pleased to have shared our thoughts and viewpoints for the summer of 2024. Happy to answer any questions that you may have, or again, talk to your financial strategist at Agili, and they'd be happy to point you in the right direction. Thanks a lot and have a great day.